All right, children, today I'm going to go over your FRQ practice with you. We did some of this in class, so I'm not going to go over those parts. All right, first question says that inflation has risen to 9%. Inflation, what we would be what we'd be trying to get, an inflation level we'd be trying to hit would be like 2 to 2.5%. So 9% is really high inflation. So this is an inflationary gap. What the Fed would need to do to fix this is they would need to decrease the money supply. And to do that, they would need to increase the discount rate and increase the reserve requirement ratio. When you increase the discount rate, it's going to become the Fed is going to charge commercial banks more money to borrow money from them. They'll in turn turn around and charge people like you and me more money, which will lead to a decrease in the money supply, which will lead to spending less. Aggregate demand would decrease. Second thing they need to do is increase the reserve requirement ratio. If they do that, they're going to cause commercial banks to have to hold on to a greater percentage of people's demand deposits. They can't make out as many loans. In addition, the money multiplier is going to be smaller. That leads to a decrease in the money supply, and aggregate demand will shift to the left. We did number 2 in class. For number 3, if net exports increase, that's going to cause aggregate demand to increase and shift to the right, and we'll be in an inflationary gap. If we're in an inflationary gap, again, we need to decrease the money supply. And to do that, same idea. We're going to increase the discount rate. We're going to make it more expensive for banks to borrow money. That's going to lead to it being more expensive for us to borrow money. And we're going to increase the reserve requirement ratio. Again, that will cause banks to not be able to loan out as much money as before. That will cause the money supply to decrease. Aggregate demand will shift to the left. Now let's look at number 4. We did not do number 4 in class. Government has increased taxes to pay off the public debt. So they're raising taxes in order to pay off debt. And so what's going to happen is aggregate demand will shift to the left as they raise taxes. We could end up in a recession. Oh no. If the Fed wants to help people get out of a recession, they're going to need to increase the money supply. If they increase the money supply, it'll make it where people have more access to money. Aggregate demand can increase and shift to the right. In order to do that, they're going to need to decrease the discount rate. By decreasing the discount rate, they make it cheaper for commercial banks to borrow from the Fed. And if it's cheaper for commercial banks to borrow from the Fed, then it's going to be cheaper for people like you and me to take out a loan. They'll also need to decrease the reserve requirement ratio. If they decrease the reserve requirement ratio, banks don't have to hold on to as much money anymore in people's checking accounts, and they can loan out a greater amount of reserves. The excess reserves increase essentially, and they can increase loans. They increase loans, aggregate demand can increase and shift to the right, and the money supply is obviously increasing. Number 6, if the unemployment rate is 8%, that's really high. Remember, our natural rate of unemployment is somewhere around 4.5 to 5%. So if we have a high unemployment rate of 8%, we're going to be in a recession. To get out of a recession, the Fed would want to increase the money supply to get people to spend again. So they want to make it easy to get money. This would be called an easy money policy. All right, so the Fed would want to buy bonds. They're going to buy bonds, big money. If they buy bonds, they're going to go to commercial banks, hand those banks cash, and take in exchange for pieces of paper that says the government owes you money. So now these banks have more cash sitting in their excess reserves. None of that money needs to be held onto. The bank can loan out every cent because it's not someone's demand deposits. That's the bank's money. They'll loan out everything they can. That's going to lead to an increase in the money supply. When the money supply increases, it's going to make the nominal interest rate decrease. If you increase the money supply, there's more money. That makes it cheaper to borrow money. The nominal interest rate will decrease. Aggregate demand will shift to the right. And we're going to end up having an increase in the price level, aka our inflation rate. And finally, if we have a fall in net exports, we're going to have the same situation happen here. Aggregate demand shifts to the right. I'm sorry, I said that wrong. Aggregate demand shifts to the left. We end up with high unemployment. The Fed would need to buy bonds. That would lead to a lower nominal interest rate and an increase in the inflation rate. All right, hopefully that helped you out. Have a great day.